Welcome back. Since we started this webcast series 2 months ago, we've discussed the pandemic, the changing markets, and their effects on business from many different perspectives that we know are important. Strategy, continuity planning, employment affairs, cash management, debt restructuring, supply chain management, government support programs. Thank you, those of you who listen in, and to our partners who share their expertise. Another fundamental angle is that of the investors. How do they see the world? What has changed? What lies ahead? Where do they see opportunity? And what do they want from companies they invest in today? For this, we have an excellent panel. Will be introduced to you soon, and a great moderator, Stephen Worthington, who leads the private equity and corporate practices of White & Case here in Abu Dhabi. Steve, please, over to you.
Thank you, Martin, and thank you very much also to the ADGM for the opportunity of being able to speak on this panel this afternoon for what will hopefully be a fascinating discussion. I am Stephen Worthington, a private equity corporate partner at White & Case in Abu Dhabi, was previously a partner in our team in London, and I personally advise a whole range of clients, including corporates, sovereign wealth funds, private equity houses, family offices and entrepreneurs. We've got a fantastic panel today that we're going to, I'll introduce you to in a moment. And as Martin outlined, we're going to be talking about the impact that the global pandemic has had on the investment world. We're clearly going through unprecedented times. This is a humanitarian and health-related crisis which has had and will continue to have far-reaching impacts on the economy and on the investment world. And that's going to be the topic of the discussion today. So we're going to be focusing on what the impact has been, what opportunities there are for both companies, businesses, and for investors over the coming months and years, and also touching on what has changed, given that we are now 4 months into the crisis. How have perspectives changed? What is the latest thinking? It's a fascinating topic. There are many areas to cover, but we're going to talk for about 30 minutes, 40 minutes, and then we would also like to give anybody who's listening in today the opportunity to raise questions through the various platforms directly to our panelists. So before any further ado, we'll move on to introduce the speakers that we have today. We've got a fantastic panel, all of whom are industry experts with significant experience who are going to share their unique insights and experience with us this afternoon. Firstly, we're joined by James Muntz. He is the CFO and COO of AD Catalyst Partners, which is a relatively new fund based here in the ADGM, a joint venture between Falcon Edge and Mubadala. AD Catalyst have been extremely active in the past year, and James brings with him a unique insight into the factors that have driven their investment decisions, and will be able to talk with great insight about how they are navigating the current turmoil. We're also joined by Annie Khatri. Annie is a managing director at Carlyle, which I'm sure most of you will know is one of the world's largest and most successful investment firms, managing over $200 billion worth of assets. Annie is one of the senior team at Carlyle, who is also going to be establishing a footprint here on the ground in Abu Dhabi, and it's a real privilege to have him this afternoon to share his thoughts. And last but absolutely not least, we are joined by Mohanad Kabaj. Mohanad is the founding partner of Olive Rock Partners, an independent private equity firm, again established here in the ADGM, who have a focus on investing in the GCC. Mohanad has a reputation for being one of the most experienced and well-respected private equity professionals in the region, and again, we are lucky to have him with us today to share his thoughts. So we've got a lot to cover in the coming hour. So without any further ado, I will move on to the general topics. And James, perhaps I can start with you if you don't mind. It's been a very busy year, 18 months. Great. Good afternoon, all, and thank you again for joining. So, James, just to kick off the discussions, we'll start with you, if that's okay. Been a very busy year for you and the rest of the Catalyst team. You've made a number of investments over the past year, 18 months or so, deployed a lot of your capital. I imagine the COVID storm has put the brakes on that somewhat. How have you and your team approached this very turbulent time, and what have been the most significant challenges that you've faced?
Thanks, Steve, and thank you, ADGM. Good afternoon, everybody, and thanks for your participation. Yeah, it's unprecedented times. We were in a probably fortunate position that a lot of the work that we put in over the last 12 months meant that we were pretty close to deal completion on a number of our deals, and diligence had been done, engagement had been strong throughout that 12 months. And so as we went into February or March, it wasn't as if we were scrambling around to get diligence done. That being said, engagement, of course, dropped off for a number of reasons, but the travel was the main one. A lot of our deals involved teams in London, New York, Europe, and the inability to see people face to face had a huge impact on getting things over the line. And so it felt on a number of deals we were 1 week, 2 weeks away, and of course that became 6, 7 weeks. I think the biggest challenge since then has been a continuation of that engagement. It feels like people are now using excuses. I think post 2008 people used excuses of whatever it was not to get things done. Brexit's been a great one in the UK and Europe, and now we're in a situation where there's another great excuse not to engage. And I think if there's a willingness to engage, you can get things done. But that engagement has dropped off a cliff, it feels like, in the last 2 or 3 months in particular.
Interesting. And what do you think is driving that reluctance to engage, other than the obvious current situation? Do you think there's any other factors at play there?
I think 2 factors. I still think post 2008 people are scared of putting their head above the parapet and making investment decisions, and are worried about being fired, for want of a better term. And the institutional investors we like to work with aren't like that, but there's still a lot of people out there that are. The second one is really dry powder. There's going to be, I would think, over the next 12 months, some tremendous opportunities, and people are wanting to keep as much powder dry as possible to go into that period. And so it's easy to kick the can down the road and use this as a very, very good excuse not to engage.
Interesting. And Mohanad or Annie, whoever would like to respond. James mentioned there about engagement and the challenges with not being able to sit face to face with management teams and the people behind the companies that you're looking to invest in. How much of a factor has that been for Olive Rock or for Carlyle? And ultimately, do you think the tools that have stepped in to replace that human interaction, the Zooms, these kind of platforms, how much of a substitute are they for basic human interaction and that face to face side of things?
Do you want to go ahead, Annie?
Well, look, I was just going to say that
I mean, I think if you look at from a pipeline perspective, if there were deals that we had in the pipeline that were sort of nearly done, and these are companies that we've known for a while and been following them for a while, I think those are easier to get done over things like Zoom. And in fact, our teams have been a bit innovative. Like on the real estate side, for example, we've actually used drones to get site visits done. So you can do technology can certainly allow you to do certain things. But I'd say, I think it's definitely a lot harder where it's a brand new management team that you're meeting for the first time, where I think there's a certain amount, in an investment business, there's a certain amount of credence that people put in meeting somebody and the chemistry that they have with that person, whether they are investing with them or whether they're seeking to raise capital from them. And I think that is hard to replicate. That body language element, which is very important. Equally, we've been able to use third-party references and other people that we work with to try and glean more information about management teams.
I agree with Ani very much, and I reiterate what you say. It's been challenging, needless to say. However, right now, what we're doing, and we're pretty much a spin out in a new company, so we don't have any historical companies we need to deal with. However, we've been harvesting right now a lot of the leads that we were sowing, I would say 6 months ago or 7 months ago, so pre-COVID time. And as Ani was saying, it's very, very important to look at the first impressions you have with the initial teams, develop the trusts with potential portfolio companies that you want to continue discussions with. And as they say, impressions are very, very important, and understanding each other and the chemistry and the body language. Now, in terms of new deals that you are interested in, I mean, you can develop conversations, you can have Zoom calls, you can use all this technology. However, I mean, I definitely think there is going to be a slight delay in interaction. You can do a lot of, let's say, desktop work. You can do some diligence. You can do financial diligence. You can look through their financial statements. However, especially when you want to do operational due diligence and conduct that, I think being on the ground is extremely important and interaction is extremely important. So I would say it's going to delay certain processes, but not necessarily hinder them to a halt.
Excellent, thank you. So that's an interesting perspective on actually sourcing deals. And then what about when you come to getting deals over the line? One of the repeated issues that we've been grappling with our clients is how you value businesses. Are you valuing them on the basis of a pre-COVID period? Are you valuing them on the period through COVID? Are you looking at projections for the future as to how you value the business? Perhaps James, how have you guys given any thought to that? Do you have any live situations where you've had to tackle that situation, and what kind of things have you been thinking about?
Yeah, look, I think it's as a sad accountant, I love modelling, I love valuations, and it's another data point. We've got hundreds of years of data of stress tests that we can run on models and portfolios. And this is another fortunate one we can have. You can ask the obvious question of how sales have been impacted in March and April, but you should be looking back at different periods in time and asking these questions anyway. I think on a public versus private debate, as we went through February and March, public equities, currencies were all over the place, oil prices all over the place. I find it a bit easier in private market where the fundamentals remain. Look at good businesses, run your models, have the right teams asking the right challenging questions, and get consensus on valuation. So it's another good data point to have to take us forward.
I think it's a very interesting question. Thank you, Steve. We are living a due diligence exercise and a due diligence period as we speak now. All right. We are under a situation where everything around us, and we are also being stress tested. All right. So looking at portfolio companies today, you are going to have two types of portfolio companies or leads, let's say, that could potentially become deals from a private equity perspective, let's say. You have the distressed deals, and we're going to come across a lot of them over the next several months. And those valuations, of course, for those companies are going to be heavily discounted to normal times. But frankly, a good deal is a good deal and will remain a good deal. And what we are looking out for is companies that are fundamentally very, very strong and that are surviving this current situation, and at the same time, teams that are nimble enough to actually make the most out of this situation, to reset, to expedite some strategies they have, and that can actually, let's say, repivot and take their company into a different direction without actually suffering. And those are two different buckets. And we don't deal with the distressed companies personally as Olive Rock Partners. But on the private equity side, a good company remains a good company. So when you look at the valuations of the private equity companies, you will understand that, yes, the whole scenario around us and the whole market around us has been muddied for the last few months and will continue to be so for the next few months. So we really have to take into consideration, how they have performed in the past few years pre-COVID. Take a look at how they have reacted and behaved during COVID, how they have survived the last few months, how their fundamentals have stacked up, how they have behaved with their consumers, with their suppliers, how they have been able to adapt to changing habits or to changing technology needs. And what I think that can be summarized as is, yes, we are very quantitative in what we do when it comes to valuations, but I think the qualitative aspect of our valuations is going to be very, very important in 2020.
Yeah. Maybe just to add to that, those are all excellent points. And, I think when people, when we're stress testing companies at Carlyle, the GFC is a reference point. And if you look at what's happened with some of the companies, the stress test for GFCs is reduction in revenues for 20, 30, 40%. I think some sectors in the COVID sort of pandemic have had their revenues wiped out 90%. So that's a new benchmark and a new reference for what might happen to certain sectors were there to be a second and third wave. And you kind of have to think about that in your valuations going forward for some sectors. And I think, the other question you asked is, there's this funny new metric that's come about, EBITDA C, which is EBITDA pre-COVID. I mean, that's it's a bit funny. You can't really rely on that because that's going to cause, and it is causing actually, the bid-ask spread to be quite wide, because you can't really hang your hat on what was your EBITDA before COVID. You really, as Mohammed said, have to look at these companies, where they're going, and do they have the ability to innovate in an environment that might hamper their traditional operations. So I think those 2 points are quite important in terms of stress testing beyond historical benchmarks or beyond what the GFC provided us, and really thinking about what this might do for companies or certain sectors that are impacted beyond GFC levels.
And I guess my question had a slightly negative connotation to it, almost about downside protection. How do you get comfortable with the valuation that you're applying to a business? But I guess the same is true for certain businesses in certain sectors. And I'm thinking here, tech in particular, one of the sectors that is booming and having a real focus here. And one of my favorite statistics coming out of this period is that the market cap of Zoom is now is greater than the 7 biggest airlines in the rest of the world, which I just think is quite phenomenal. But I guess the valuation question also applies for these COVID-resistant businesses or COVID-accelerated businesses, if you like. Like, how do you get comfortable to jump in now on a business that is, making hay during this difficult period, and not kind of miss the boat and hold off, and then to make the same decision in 6 months' time when valuation has increased 20, 30%, whatever it might be, because there's a different side to the same coin, right?
Yeah.
There is, I can start, I suppose, Steve, exactly right. Same process. You do your work. If it's a good company and you think you're 20 or 30% over, but you think there's a runway for it being double the valuation it is now in 18 months, then it's still a good investment. I feel like I've banged on about biotech for 10 years and I've definitely missed the boat. But picking the right stocks for that is very, very tricky. But go back, do the fundamentals. Don't try and buy on the wave. Do your work, do your due diligence, and if it makes sense, then it makes sense. But yeah, there's a lot of people using the expressions "catching a falling knife" at the moment, and it is that environment again. Where are we going to bottom out? Where are we topping out? But do the fundamental work, grain consensus, model it, stress test it, and reach consensus.
But this is also a time, I just want to add one more point, if you don't mind. This is also a time where alternative asset managers, be it private equity or infrastructure or private debt, can add a lot of creativity in terms of structures to the deals. And in some cases, actually hedge their exposure and slightly de-risk during this interesting period. And for example, stronger earnout structures, back-ended payments, profit sharing. Somehow, when you are thinking qualitatively and diligencing qualitatively a specific deal and betting a lot on management's abilities to actually redirect the ship, you want to tell them, you know what? This is what you're trying to convince us of. We believe you. We believe in you. And how about we share the success story rather than pay you out and cash you out now? So right now, this is the strength of well-funded alternative asset managers, is the creation of these structures.
Yeah, thanks, Mohammed. A number of really. Sorry, Annie, go on.
No, I was just going to echo Mohammed's thought that structures are very important. So how you kind of think to protect your downside, especially when you have companies that are sort of really innovating at the moment. And I think what this pandemic has done is already accelerated the growth of certain sectors. So the cloud sectors and companies in that sector have really benefited from this. Those valuations were high; they're going to get higher. But you really kind of have to think about structures that you can put in place to mitigate the downside when you are investing in such companies.
And I have one more point, if you don't mind, but it's also interesting for people who want to be contrarian as well. So are people going to stop traveling? No. Are people going to stop staying in hotels? They're not. What's happening to hospitality? Yes, it's decimated today, but it would be quite interesting for alternative asset managers to actually look on a contrarian basis at some of the sectors which temporarily are going through a very, very strong glitch, even though fundamentally they've been strong, but right now they're taking a breather. So I think there's a lot of trial and error at the moment in terms of thought processes, but hopefully, we all come out strong.
And I think that's a number of very valid points there, Mohammed, and particularly if you're taking a kind of longer term view of things. But before we jump in to talk about where we're seeing the opportunities, I just wanted to ask Annie actually a question. Yes. Given we've got the benefits of you on the panel, obviously Carlyle, one of the world's biggest private equity houses, one of the world's most successful investment firms. What has changed at your IC level? From the moment this first arose and everybody became aware of this issue to the 4 months now that we've all been, or 4 or 5 months that we've all been living through this, how have views changed? How has the strategy changed? What are people thinking about and talking about at ICs that they weren't talking about before?
Yeah, no, absolutely. So, I don't think the strategy has changed, and our process really is, was very rigorous and continues to be very rigorous. But the fundamental stress testing of what we're doing for forward-looking projections, that process has changed a little bit, right? Your asset selection has changed. People, as I said earlier, were using the GFC as a reference point. That is a valid reference point in some regards, but COVID has really upended everything, and you kind of have to come up with, sort of a new reference point that, is from this era. As I said, some businesses have had their revenue wiped out 90%. So you kind of have to take that into consideration. EBITDA that just doesn't stand. And I think we're really encouraging teams to think about asset selection and what sectors would benefit over the next sort of 2 to 3 years. As Mohammed said, contrarian view, travel certainly will pick up at some point. Maybe in 5-10 years, travel will be back to where it was and even greater. But the private equity structures, we've got 10-year fund lives, so we have to think about sort of the next 4 to 5 years, and sort of what are the companies that we're going to buy now going to do in the next 4 to 5 years. And so that's what we're thinking about. And what is going to be the impact of COVID over the next 3, 4, 5 years.
Great, thanks, Annie. And I guess the similar questions to Mohammed and James. Where are you guys seeing opportunities moving forwards? Is it all tech and digitally driven businesses, or is it more nuanced than that?
I think we are seeing a lot of habitual changes. All right, so we need to overlay the habitual changes of the consumer in general with what we want to look at as actually valid and sturdy businesses. And I think very interesting areas which are fundamentally strong and I think will actually be stars going forward are, needless to say, healthcare. So healthcare is an area, and social infrastructure as a whole, and the variances within healthcare, as well as education as well, and online education. Those are two areas which are very important. Of course, you look at technology and technology enablement. That is extremely important. So not just technology and investing in tech, like the Zooms, etc., or digital payments, etc. But if you look at companies, a lot of brick and mortar companies have been delaying their technological, let's say, adaptation and enhancement. And this is a time where they've all been expediting this. So you're going to have a lot of companies which, if they're fundamentally strong, if they have good funding power, they can actually grow from being a value company into a growth company because of this expedited, let's say, tech enablement. So I think definitely technology, definitely healthcare, definitely education, and their varieties and their peripherals, and also companies that benefit from the region's location. So we're seeing a lot in terms of logistics and e-commerce, and especially that this region is on the cusp of 3 continental-hour flight radius from over 21 countries and 8-hour flight radius from 2/3 of the world's economies and populations. I would say for us, those would be the focus areas.
Great. And James and Annie, obviously Mohammed has a bit more of a GCC focus, both AD Catalyst and Carlyle more of a global footprint. Do you think there are, as well as sectors, are there countries or regions that are going to provide greater opportunities than others with the way this is all going to play out, or not?
Yeah, no, look, I think from my point of view, it's maybe it's more hope than expectation on the country side of things. I think countries have proved themselves to be failing in cooperating with each other, and everyone at the moment seems very inward looking. I think the big question on a macro level is China, the relationship the rest of the world wants to have with China. What are the, reliant on China for producing everything in the world. My little boy said to me this morning where a sale was made, and without even thinking about it, I told him China. And then he asked why, and I said everything's made in China, and that's the reality we live in now. And what's that going to look like going forward? And my hope is that countries that embrace a lot more cooperation, and you see that in the UAE to a great extent, wanting to reach out to help other countries to cooperate as much as possible for the greater good, will hopefully benefit more than the countries that are much more inward looking. That being said, there's great opportunities in a lot of those countries as well, and investors still want great returns, and the balance of that is going to be interesting to see how it plays out.
I think you've touched on a couple of really interesting points there, and topics that we could probably talk about for hours to come. But that kind of rise of this anti-China sentiment, and the threat of kind of increased foreign direct investment regulations in certain jurisdictions, we think that that's coming very quickly in EMEA, and we'll be on us before we know it. Annie, do you feel this is kind of the beginning of the end of globalization, or a move to a slightly different era, or is that overstating things?
Yeah, it's I was thinking about this, and I think COVID's going to be a blip in the trend of long-term globalization for humanity. I can't see how in 50 years or 100 years we're not a more global planet if we're still around. So, are there going to be restrictions on strategic industries like aerospace and defense, healthcare, tech? right now in the era that we're in? Absolutely. You know, you're seeing what's happening in the US, very inward-looking relationships with China. Absolutely, there's going to be questions asked there, and you know, everyone's trying to protect their healthcare intellectual capital. But you're also seeing pockets of regional collaboration and coordination, right? So the EU and the UK, to a degree, are also all collaborating with each other. Western governments are trying to collaborate with each other, and so I think, you know, longer term, the politicians that are more inward looking, their terms will end. You know, hopefully we'll overcome COVID, and the world will continue to be a global place. So do you think about redundancy in your supply chain and trying to bring some components of that onshore? Sure. Can you bring everything from China onshore? No, because you don't have the necessary skill in your, you know, let's take the US, for example. There's a massive skill gap there. There's a massive, you know, sort of capital investment needed for the manufacturing capability that China has. It's going to take them a decade to, you know, overcome some of that. How do you overcome the skill gap when your, you know, your immigration policy is not sort of favorable to letting sort of brain power come in? So these are, I think COVID's going to be a blip in the long-term trend of globalization, and we certainly continue in that direction once we overcome this. And I think, you know, once the initial fear subsides, people will find, and countries will find, that there's more benefit to collaborating with each other than not.
But I think you're going to see a lot of strategies, governmental strategies, I would say, shift and become a bit more refined when it comes to localization as well, especially in some sensitive sectors. You mentioned technology and aerospace, but I think also when it comes to, for example, food security, I think we're going to see a lot of localization under the spotlight going forward. And even in places like, you know, the UAE or Saudi Arabia, where, you know, water is at a massive shortage, they are all looking at, you know, importing, for example, cows to set up dairies here just for food security. So I think you're going to see some sectors here which will benefit from localization and support and subsidies that the governments will actually provide them. So it would be interesting to play in those spaces as well.
And we touched on some of these points a little bit earlier on about the benefits that, you know, private equity or partnering with investors can have for businesses and for investee companies. Can you talk about that in a little bit more detail? You know, particularly in the current circumstances that we're in at the moment, what can you know, an external investor bring to help a portfolio company navigate, or a business rather than a portfolio company navigate through the, you know, the challenges that they're facing at the moment? Mohammed, do you have a view on that? You were touching upon some similar themes a bit earlier.
Yeah, well, you know, interestingly enough, is right now I think portfolio companies really need smart capital rather than just purely passive capital. People in general are very comfortable in what they've been doing for many years. To some extent, people are apathetic. You know, apathy is not pathetic, apathetic. So apathy is always a bit of an obstacle and a hurdle. And you have a lot of portfolio companies and management teams who are comfortable in how they've been running their businesses. And now they realize they really need to be nimble, and they really need to be malleable with the changing world. This is just an example of how the world is changing. You never know what's going to happen in the future from a technology perspective, regulatory perspective, global trade perspective, globalization perspective. And bringing in third-party capital is great, but it has to be smart capital. And alternative capital investors, be it private equity or private debt, should be able to come in and add value operationally in terms of supporting the management, add value strategically, and add value financially. And I think you're going to see a lot more people who are willing to listen, especially on the proprietary deal sourcing front. A lot of people who are going to be willing to listen and say, okay, I need help. And what has happened this year showed me that it has triggered the essential notion that I do need help. How can you help me? And we really need to create a win-win situation, because this can be very beneficial for us in finding very good deals as well.
Yeah, no, absolutely. I mean, I think that from a Carlisle perspective, it's something that we've been doing pre-COVID as well. We have a centralized group of resources called One Carlisle, where when we look to invest in a company, we're providing them with things like human capital management support. You know, how do you optimize your capital structure? We've got a team that sort of helps going out and refinancing debt. IT systems, you know, data security is getting more and more important these days. Everything is kind of moving to the cloud. People are working from home more. People are, you know, doing doctor's appointments online more. So all this data infrastructure, all of that needs to be sort of held securely, and people need to think about how they're going to scale their data infrastructure. So things like that, government affairs, you know, that's a sort of invaluable area where, you know, things are changing so fast, and really, how do you help your portfolio companies navigate all the different changes and regulatory regimes that are taking place around the world, especially in a time like COVID? This becomes increasingly important, and you know, is absolutely essential in helping your companies get through this.
Yeah, I think, Steve, when I was preparing for this last night and thinking about what we wanted to touch on, I kept coming back to strategic partnerships, and I think that was key before the pandemic, but is even more key now. And it's whether it's, you know, understanding that extending an investment term is the right thing to do, or providing working capital assistance for a prolonged period of time so you don't have to do deals for the sake of doing deals, are all things you're going to get from a strategic investor rather than a passive investor. And I think this is just heightens that again. Be active investors, be partners to their business, understand their needs, their pain points, bring the expertise you can do, and be a genuine friend and partner to businesses.
Thanks all. Maybe we continue that strand of the discussion to focus a bit more on the portfolio companies and on businesses rather than you know, from the investment side of things. What do you think have been the biggest challenges facing businesses and companies since the COVID crisis, the storm first appeared? And the steps that, you know, if you were sitting there as a CFO, James, of a portfolio company now, what are the kind of key steps that they should be taking, you know, as a matter of urgency if they haven't done so already?
Yeah, so I mean, we typically invest in funds and fund management companies, investment managers, and it's the age-old discussion about enterprise risk management that, on the whole, investment firms and funds don't take seriously enough. Understanding their investor concentration, what their break-even AUM is, what a dip in performance means, what are the fund liquidity terms that you're offering, what are the side pockets you're offering, and in a stressed scenario, what does that mean for your business and what does that mean for your cash flow? And understanding how that impacts the enterprise risk of your business rather than the actual fund performance is something, again, we're reaching out to all of our partners and peers that I've worked with over the years, and, you know, screaming, establish where you are, where is your break-even AUM, how much cash have you got, you dip below that, at what level do you need support, how many strategic investors can you reach out to for support in times of stress? And people in these sort of environments, especially if you're fund managers, you get pulled into the weeds of performance. All your investors want to know, how's performance, how, you know, where are we, and they tend to not think about their enterprise risk as much. And so very much trying to point them in that direction and help them understand that.
Great, thank you. And Annie or Mohammed, anything else that you'd like to add to that? Any steps? Obviously, Mohammed, Olive Rock's a relatively new fund, but Mohammed, Annie, when you were liaising with your portfolio companies when this all first started to emerge, were there any kind of things that you were recommending, that the steps that they all took right at the outset?
Yeah, I mean, look, from a liquidity perspective, I think we've kind of recommended to many companies to help or to have them draw down on their revolvers. So, you know, they have funding certainty at least for the next sort of 6 to 12 months. So that's something that many companies have done just throughout. And I think the second biggest area that we've been able to add some assistance, second and third, is sort of around IT and digital infrastructure, right? So not everybody was geared up to be working from home. And so we've really been able to share those best practices across portfolio companies, also provide a forum for our CEOs, CFOs, our chief IT officers at each of our portfolio companies to share, exchange, and talk about what's working, what's not working, and how to adopt best practices. So I think that's been invaluable. And again, government affairs, sort of having our government affairs teams work with each of our portfolio companies and help them think about sort of what some of the changing regulations mean for their employees, for their payroll, etc. I think that's also been particularly valuable and well received by the companies.
So it's really getting into the operational weeds in a way that perhaps you weren't doing previously. And Mohanad, do you think it's all doom and gloom for companies and for businesses, or are you seeing any lights at the end of the tunnel? Is there any reason to be optimistic? You talked a little bit earlier about pivoting and flexing the approach that businesses are taking during this time. What kind of things were you thinking about there?
I think it all depends on the sector. So you have a lot of companies that are well capitalized, that are well funded, that can survive, all right? Can survive the 3 months, survive the 6 months, survive the 9 months. But other companies, unfortunately, who are dependent on contracts, let's say, that are not paying, or governmental and semi-governmental projects that are stalled. A lot of smaller companies, I think, are going to be suffering because everyone can survive for a month, potentially 3 months, but 6 months and 9 months might be difficult for many. So I think you're going to see the differentiation between two types of companies, and I'm generalizing very, very, very much, so this is high level, between companies which are going to be at different levels on a scale of being distressed versus different companies which are at different levels being comfortable or slightly uncomfortable. And I think we're going to see a lot of that. And, our job is to be able to qualitatively find out which is which and partner with them. I don't know if Steve is concentrating hard on something or...
I think we've lost Steve. MQ, shall I, Annie, James here. I think we've spent 40 minutes running through most of the topics we wanted to cover. There's a few questions we've got. Perhaps I can pick up one of the first questions, and starting with you, MQ. Do you think it will be emerging or developed markets are going to come out of this more favorably over the next 12 to 24 months?
Frankly, I think it's going to be a bit of a surprise, because if you look at the US, for example, the economic impact was eased of course, by aggressive fiscal stimuli and measures. But if you look at the social impact, they are at dire levels today, And then you look at Brazil, which is an emerging market, but rapidly growing, it's suffering on all fronts. And then you look at something like the GCC, where it's more developed more than emerging, is weathering the storm better than many. And that's due to immediate action taken by the leaders, plans to prop up the SMEs, increasing transparency, easing residency regulations. So I think we're going to see a few surprises. I mean, no one expected countries like, Jordan, for example, to be on the top of the list globally in terms of weathering the storm. I'm not saying specifically economically, but non-economically. So I think we're going to see quite a few surprises, but let's face it, at the end, it all comes down to fiscal stimulus and economics. So at the end, the economy is going to be the ultimate driver, and developed markets which can support the economic landscape and infrastructure are going to, let's say, recover a lot quicker.
Annie?
Yeah, I'd have to agree with that. I mean, I think there certainly will be a few surprises, but when the US certainly has a set of challenges at the moment. You have a big election year coming up as well, and the outcome of that. Whilst the polls are showing one thing, we also know what the polls showed the last time around, so wouldn't really put much credence in that. But the US remains a center of innovation, a deep capital markets. And what we're seeing with these new fast-growing businesses is that they're not really tied to a geography, right? So Zoom is it a Chinese company? Is it a global company? And they're certainly being used by everybody. And if you look at all the other cloud computing companies that have done so well in this past period, they're on their way to being truly global companies. So I think it's more business models. I think that you have to look at. Rather than just, of course, those business models are they'll be impacted by what's going on in their particular country. But I'd say, more and more, you kind of have to look beyond just that myopic view.
Yeah, no, agree completely. I think we've got Steve back. I'll just add that I hope as we go into another big election year and we talk about public policy, that again, it's for the right reasons, and public policy is driven by the greater good and not by vote winning. But again, maybe that's much more hope than expectation. Steve, you back? We still can't hear you that well, Steve. We had a question from the people on the panel about inflation. Very, very quickly, and I'll touch Mohammed and Annie if you've got a view on it. Inflation feels like it's coming down the road. How do you play that? Well, embrace it. Look at asset classes that benefit from it and run with it. Annie?
Yeah, look, I mean, I'm not an economist, right? And inflation has been coming for a while. So, what we know is that the interest rate environment is going to remain low for at least the foreseeable future. There's not any way any of the governments and central banks can increase rates at the moment, and they've all kind of very clearly broadcast that. So that kind of, you have to think about alternative strategies where alternative to fixed income, I mean, where you might try and make those returns. So, real assets, credit, secondaries might be some areas that investors could look to, get some yield.
Mohammed?
No, I agree. I agree with Annie. There's a question here, which I don't know how relevant it is to the panel here, but it's just a bit of a high-level question about real estate. And I think people are asking, in terms of real estate investment. And I think this has nothing to do with private equity or credit, but does anyone have any opinions on that? Because we've got a few of those questions that keep popping up. Annie, anything about, especially in the UK at the moment?
Yeah, well, look, it's interesting. I mean, you kind of have to look at it on a very subsector by subsector level within real estate. Logistics, absolutely going to boom. Had a tailwind to it, has a massive tailwind to it. The call on office is an interesting one, right? Do we think in 3 years we're not going to be going to the office? I don't think so. I think we'll still be going to an office. Will we be going to office 5 days a week as we have been? I think Zoom's taught us that we could do a lot of things remotely. There's a huge amount of productivity taking out a commute, even for a day, that can add into a person's life and quality of life. So will we need as much office space going forward? Probably not. So that, the office sector might be one to watch to see, what developments occur there. A company like WeWork already disrupted it, but then sort of has gotten disrupted itself because they have short-term subscription model where, at a moment like this, I think many people would have probably withdrawn their subscriptions from WeWork. So, residential, what does this do to inner city residential? Are places like London going to be ghost towns? I don't think so. Do people want more space and might look to live outside of major cities? Yes, but we can't kind of think that this is going to continue forever. So I think city centers will still continue to be important places. So you really kind of have to pick your spots within the subsectors.
Yeah, I think the question is a fascinating one. Should you be staying away from real estate? I probably have opinions above my station, but no, to Annie's point, there's going to be some great opportunities. I'm fascinated by what happens in the care home system for elderly and for children. We've been in an environment of finding schools and nurseries, and how does that change with people working from home? And then with the elderly, are we going to be able to spend more time with elderly people? Could be a really interesting place that, if you'd asked me 12 months ago, very, very long on care homes and palliative care for the elderly might not need that as much now as we move into a working from home environment. And so it's going to be a fascinating 24 months as we see what plays out in the macro picture, but certainly don't stay away from real estate for the sake of it, I would say.
Just on the point of real estate, I mean, if you look at the mortgage numbers that came out of the US today, they're very, very strong. So people are certainly looking from a residential perspective, perhaps to upgrade their situation or change the situation. So, residential still remains quite strong in the US.
Yeah, no, absolutely. I suppose the final question for each of us to answer is, on a personal level, what have you learned through the last 3 months in terms of practical lessons learned or perceptions learned? Mahan, if we'll start with you.
Yeah, look, what I've learned is worst case scenarios can happen. I mean, we all stress test and say, what if? Well, the if happened. Always be prepared for that. Stress test in a much stronger fashion. It has to be taken a lot more seriously, I think, in diligence as well, but also be prepared for the need to rescue. This is very, very important, and it was mentioned by everybody on the panel in a different manner. Rescue capital and creating a buffer is extremely important. And also what's very, very crucial is the readiness and the ability to accept and react to change. This is extremely important. We were in a world where everything moves very, very fast. And unfortunately, we've seen in the last few months, it has moved very, very fast in the wrong direction. So one has to be always prepared. One has to be always ready to create buffers to support what they are doing, be it their own funds, be it their portfolio companies, and at the same time, to be very, very malleable to potentially change and to accept it.
I think just picking up on your point on innovation, these periods of disruption really serve as a reset, right? So if you look at the GFC, it served as a reset in certain areas. This is serving as a reset, and I think innovation is a key area coming out of this, and kind of embracing that change and embracing that innovation in new directions, and kind of just really thinking about what have we been doing without thinking about, and kind of challenging those things, right? So I think one of the things coming out of this, people are trying to come out of this a lot greener, right? So what ESG implications does that have for portfolio companies in how you run your life? The choices that we make. I think that this has hopefully helped us think through those questions and decisions, and will help us make some more informed decisions for our collective futures, because it's clear that growth at the cost of certain communities of the planet is just not a sustainable strategy, and we really should challenge ourselves and everybody around us to think about a more sustainable and inclusive growth environment for everybody as well as the planet.
Yeah, no, look, I agree. I think it's important every now and then to reset, both on a personal level, on a business level, on a country level. And sometimes we go along blind. It feels like the world needed a rest at some point. Seeing some of the nicer things, trees in bloom, and taking more time to enjoy nature on a personal level is lovely. But the opportunity for companies to reset themselves is one that's needed. I think we've seen the best and the worst of humanity at times. It's been great to see the support for key workers, the support for people who have been under support. I think anyone who has children who's gone through home education really probably appreciate the difficult task that teachers have. And that's been beneficial when we take a breath and we think about that. Look, thank you guys, Mohammed, Annie, it's been great chatting. I'll hand back to Martin now to wrap up.
With me, those of you who listen, that this hour has come to an end way too soon. This has been an extremely interesting discussion, I think. Thank you, first of all, to all of those of you who listen and post questions. I know there are a few we didn't have, time to address. I'll encourage the panelists to have a look in the LinkedIn feed and see if there are any points we perhaps can address afterwards. Also, and most foremost, a huge thank you to our panelists, Ani, Mohamed, James, and Stephen. You listen in the dark, but I know you're with us still. Very interesting perspectives, thought-worthy, and on many levels also reassuring of the concern for the now and for the future that you have communicated is there in our business community and among our investors. Again, everyone, thank you very much and look forward to reconvening again next week around yet another webcast. Thank you, everyone.